In this chapter, we study two important features of long-term life and health insurance contracts: surrender values and policyholder bonuses. Both topics are closely connected to the actuarial reserve, but they address different questions. Surrender values concern what happens when the policyholder terminates the contract before maturity. Policyholder bonuses concern what happens when prudent pricing assumptions generate a surplus that should be returned to policyholders. The common thread is the multi-state valuation framework developed throughout the course. We will see that the same modeling language can describe contractual options, reserve reductions, technical margins, and the equitable redistribution of surplus. The presentation is organized in 4 parts. We first introduce the main ideas of the chapter. We then study surrender values and show how they can be represented by an additional absorbing state. The second major part is devoted to technical surplus, first order and second order basis, and the surplus process. Finally, we discuss 3 bonus allocation mechanisms and illustrate their consequences with a disability insurance example. The chapter has 2 main objectives. The first is to show how surrender values can be introduced into the multi-state framework without changing the basic architecture of the model. A policyholder may terminate the contract early, and this decision is represented as a transition toward a new absorbing state. The intensity of this transition measures the tendency to surrender, exactly as mortality, disability, recovery, or other biometric events are represented by transition intensities. This is a useful modeling idea because it treats surrender as one more possible exit from the current contractual situation. The second objective is to understand policyholder bonuses. Long-term contracts are priced using technical bases that are often deliberately prudent. These first-order bases protect the insurer against systematic errors in financial or biometric assumptions. However, if experience is closer to realistic second-order assumptions, prudence creates a technical surplus. From an actuarial equity point of view, this surplus cannot simply remain with the insurer. It must be redistributed, at least to a large extent, to the policyholders who contributed to its emergence. The chapter therefore connects reserves, surrender penalties, prudential margins, and bonus mechanisms. The central message is that both surrender values and bonuses can be studied through the same prospective valuation logic. Compare future obligations, define the relevant reserve, and identify how contract design changes the cash flow balance. We now begin with surrender values. This part is deliberately short but important because it shows how flexible the multi-state approach is. Instead of introducing an entirely new valuation theory for early termination, we only enlarge the state space. The policyholder's contractual right to surrender becomes a transition, and the surrender payment becomes a transition benefit. In a life insurance contract, the asymmetry between the insurer and the policyholder is fundamental. The insurer is generally not allowed to terminate the policy unilaterally when the insured becomes less healthy or when the probability of future claims increases. This legal restriction protects the insured against opportunistic cancellation by the insurer precisely when coverage becomes most valuable. The policyholder, however, is often allowed to surrender the contract at specified dates, usually subject to contractual notice requirements. When this happens, the insurer pays a surrender value. This payment should not be interpreted as a new benefit unrelated to the reserve. It is better understood as a commutation of the insurer's future obligations. Instead of maintaining the contract until maturity, the insurer makes an immediate payment and the policy ends. Not every contract includes such a value. For example, long-term care annuities may have no surrender value because allowing termination and cash recovery would be inconsistent with the insurance objective. The surrender charge is the gap between the reserve and the surrender value. It compensates the insurer for early termination and can also reflect acquisition costs and adverse selection. Since the remaining term becomes shorter over time, the charge is generally decreasing as maturity approaches. The modeling device is straightforward. We start from a policy represented by a finite state process with states describing the relevant contractual situations. For example, active, disabled, unemployed, retired, or deceased. To include surrender, we add one extra state. Entering this new state means that the policyholder has surrendered the policy at that time. The new state is absorbing because once the policy has been surrendered, there are no further contractual rights or obligations under the original contract. No premiums are paid in this state, and no subsequent benefits are generated. all transition rates among the original states remain unchanged. This is important because the surrender extension does not rewrite the underlying biometric model. It only adds an additional possible transition from the existing states. The new intensities describe the local propensity to surrender from each state. In practice, surrender may only be meaningful from some states. In many contracts, only an active policyholder can surrender, so the surrender intensities from other states may be set equal to 0. This construction is useful because it permits surrender behavior, contractual benefits, and reserves to be handled by the same system of Thiele equations used for ordinary multi-state insurance. It also makes empirical calibration possible. Lapse or surrender experience can be estimated as a transition intensity and then combined with mortality, disability, or recovery assumptions in a unified reserving model. The surrender payment is the amount paid when the policyholder moves from one of the original states to the surrender state. The chapter imposes condition 10.1. The surrender value must not exceed the mathematical reserve computed without surrender. The interpretation is simple. The reserve is the prospective value of the insurer's future obligations net of future premiums. If the policyholder receives more than this amount upon surrender, the surrender option would create an immediate gain relative to the actuarial value of the contract. Condition 10.1 rules out that situation. The difference between the reserve and the surrender value is the surrender charge. This charge is specified in the contract and is paid implicitly by the policyholder through a lower cash amount at termination. From the insurer's point of view, the charge reduces the liability associated with early termination. From the policyholder's point of view, it is the cost of leaving the contract before the agreed maturity date. If the surrender value is exactly equal to the reserve, there is no surrender charge. In that limiting case, surrender simply exchanges the future reserve value for an immediate cash payment without creating a margin for the insurer. The condition also explains why surrender values are contract-specific. They depend not only on expected future benefits, but also on the way the contract allocates the cost of early exit. The key reserve comparison is between the original model and the enlarged model with surrender. The reserve in the enlarged model is denoted with a star, while the original reserve is computed as if surrender were ignored. The chapter considers the difference between these two reserves. After subtracting the two Thiele equations, the surrender charge appears as a non-negative benefit stream. The reason is that whenever surrender occurs, the insurer pays less than the original reserve if a charge is present. This saving is weighted by the surrender intensity because it can only arise when the policyholder actually moves to the surrender state. The representation formula following the subtraction of the Thiele equations expresses the reserve difference as the discounted expected value of this non-negative stream conditional on the current state. Since all terms in this representation are non-negative, the conclusion follows immediately. The reserve with surrender is less than or equal to the reserve without surrender. If the surrender charge is strictly positive, the inequality is strict, at least whenever surrender can occur with positive intensity. If there is no charge, the two reserves coincide. Thus, surrender lowers reserves only because the surrender value is below the mathematical reserve. Notice that this is not a statement about whether surrender is profitable in practice. It is a prospective valuation result conditional on the contractually specified surrender benefit. We now move to the second and larger part of the chapter. The focus shifts from early termination to surplus generation. The central question is no longer what happens when a policy is surrendered, but how prudential margins embedded in premiums and reserves generate a technical surplus and how this surplus should be redistributed to policyholders. Life insurance contracts often last for decades. This creates a serious difficulty for the insurer because premiums and benefits are usually fixed at inception and guaranteed for the entire contractual period. The insurer therefore faces a non-diversifiable risk. If the interest rate, mortality, disability, recovery, or other transition assumptions are systematically wrong, the whole portfolio may be affected in the same direction. The traditional actuarial response is to use prudent first-order bases. These bases are used for premium calculation and reserving, and they include safety margins. In contrast, second-order bases are best estimate assumptions designed to reflect expected experience. The chapter writes transition intensities and discount rates under both bases, and all formulas from the previous chapters may be evaluated under either set of assumptions. The analogy with financial mathematics is useful. Moving from second-order to first-order bases resembles a change of measure, with second-order bases playing the role of the physical measure. Premiums are fixed using first-order bases, while benefits are the same under both bases. The equivalence principle says that at inception, the first-order reserve in the initial state is zero. Therefore, any expected surplus under second-order basis reflects the prudential margin built into the contract. Policyholder bonuses are represented by a cumulative payment process. Their role is to restore actuarial equity when the contract is evaluated under second-order basis. The displayed condition is equation 10.2 in the chapter. It states that the expected present value of premiums minus benefits and minus bonuses must be zero under the realistic basis. Without bonuses, prudent first-order premiums generally create a positive expected surplus when the actual experience follows second-order assumptions. This surplus has a different nature from ordinary pooling gains. Random claim fluctuations can be diversified in a large portfolio if the model is correct. By contrast, the risk considered here is systematic. The insurer may have chosen financial or biometric assumptions that are too conservative or, in adverse cases, not conservative enough. The first-order basis is intended to protect against this non-diversifiable uncertainty. When the conservative assumptions turn out to be favorable to the insurer, the resulting margin should largely be returned to the policyholders. At inception, because premiums have been calculated so that the first-order initial reserve is zero, the expected technical surplus is the opposite of the second-order initial reserve. This quantity measures the expected value created by prudence before bonuses are paid. The surplus process provides the dynamic view of the same phenomenon. The chapter first defines the accumulated value of premiums minus benefits up to time t using the actual accumulation rate associated with the second-order basis. From this accumulated amount, the insurer subtracts the first-order reserve required at time t for the current state of the policy. The result is the surplus process, introduced in equation 10.3. Economically, this is the amount already accumulated from past net cash flows after setting aside the prudent reserve needed for future obligations. At time zero, the surplus is zero because the first-order equivalence principle is imposed. When the process is differentiated and Thiele's equation is used under first-order basis, the dynamics split into three terms. One term is the interest earned on the accumulated surplus. A second term is the predictable technical surplus. This component is generated by financial gains, when actual accumulation exceeds the guaranteed technical rate, and by biometric gains, when prudent transition assumptions are favorable. The third term is a martingale, reflecting the random timing of transitions. This decomposition separates systematic surplus generation from random portfolio fluctuation. It also explains why bonuses should be linked to the predictable component rather than to short-run random gains and losses. The local surplus rate describes how much predictable surplus is generated at a given time when the policy is in a given state. The displayed expression should be read as the sum of a financial component and a biometric component. The financial component compares the second-order accumulation rate with the guaranteed first-order technical rate. If the actual rate is higher than the guaranteed rate, then the reserve earns more than was credited in the technical calculation, and this creates surplus. The biometric component is more subtle because its sign depends on the capital at risk. The capital at risk is the transition benefit plus the reserve after transition minus the reserve before transition. If this quantity is positive, the transition is costly to the insurer, so prudence means assuming a first-order intensity higher than the best estimate intensity. If the capital at risk is negative, the transition releases reserves, and prudence may instead mean using a lower first-order intensity. This explains why a prudent mortality assumption is not always a higher mortality rate. It depends on whether death produces a net payment or a reserve release. The formula therefore gives a precise actuarial criterion for identifying the sources of technical surplus. It also prevents a common modeling error. Prudence must be defined transition by transition, not by applying the same direction of stress to every intensity. The difference between first order and second order reserves is the reserve margin. Equation 10.5 shows that this margin can be represented as the expected present value of future local surplus rates evaluated under second-order transition probabilities and discounting. This is a powerful interpretation. A first-order reserve is not merely a conservative number. Its excess over the best estimate reserve corresponds to future financial and biometric gains expected to emerge from the prudential assumptions. The condition that the second-order reserve is not larger than the first-order reserve is therefore an expression of prudence at every time and in every state. It is satisfied when the expected technical surplus rate is non-negative in the relevant prospective sense. This result also clarifies the link between reserving and bonus capacity. If the first-order reserve margin is large, the contract contains a larger expected surplus that may later be distributed to policyholders. If the margin is small or negative, bonus capacity is limited, or the insurer may face losses. Thus, bonuses cannot be studied independently of the technical basis used to price and reserve the contract. The equation also gives a practical diagnostic. Projected future surplus rates should reconcile with the observed gap between statutory and best estimate reserves. The unemployment insurance example illustrates how the general sign conditions translate into concrete actuarial assumptions. The model has two main living states, active and unemployed. Premiums are paid while the policyholder is active and benefits are paid during unemployment. The chapter shows that in the absence of deductible and waiting period clauses, one can compare the first order and second order reserves by studying the signs of the relevant reserve differences. A sufficient condition for prudence is that the second order interest rate is at least as large as the first order technical rate. This means that the insurer guarantees a conservative accumulation rate and expects to earn more under realistic assumptions. For unemployment entry, prudence requires the first order intensity to be higher than the second order intensity, because moving from active to unemployed leads to benefit payments and increases the liability. For unemployment exit, prudence works in the opposite direction. The first order recovery intensity should be lower than the second order intensity, because recovery reduces future benefits and improves the insurer's position. This example is useful because it shows that prudence is not simply about increasing all transition rates. The direction of the safety margin must be aligned with the capital at risk. We now turn from surplus generation to surplus allocation. Once a technical surplus has been identified, the actuarial issue is not only how large it is, but also who should receive it and when. The chapter presents three classical mechanisms: annuity bonuses, terminal lump sum bonuses, and increasing proportional bonuses. The fundamental allocation principle is that surplus should be returned to the policyholders who contributed to its emergence. The chapter formalizes this idea by defining the expected present value of surplus generated while the policy is in each state. This quantity combines three ingredients: the probability of being in that state under second-order assumptions, the discount factor, and the local surplus rate generated in that state. Summing over all states gives the expected present value of the total technical surplus up to time t. This decomposition is important because technical surplus does not arise uniformly across policyholders or across states. Some policyholders may spend more time in states where prudential margins generate large gains, while others may already have received substantial benefits. An equitable bonus mechanism should therefore compare the expected surplus generated by a policy with the expected value of bonuses granted to that same policy. Allocation methods differ in two dimensions. The first is timing. Surplus may be paid as it emerges, accumulated and paid at maturity, or converted into additional guarantees. The second is attribution. Bonuses may be linked to the current state, the terminal state, or the evolving benefit package. These choices determine whether the mechanism is actuarially credible. The first allocation method pays bonuses as annuities. When the policy is in a given state, the local surplus rate is paid to the policyholder, either as a reduction in premiums or as an increase in benefits. Conceptually, this method is very transparent. Surplus is returned as it emerges, and the expected present value of distributed bonuses matches the expected present value of generated surplus. In practice, however, insurers would not distribute the surplus continuously, Bonuses are usually credited annually or at other discrete dates. Moreover, immediate redistribution may be imprudent when the surplus component can become negative, especially for interest rate guarantees. If the actual rate falls below the guaranteed technical rate, the insurer cannot ask policyholders to repay past bonuses. The second method accumulates surplus and pays it as a terminal lump sum. A policyholder in a given state at maturity receives an amount obtained by dividing the expected surplus generated in that state by the discounted probability of being in that state at maturity. A variant rewards only policyholders in the initial or active state at maturity. These methods are simple, but they can produce questionable allocations because terminal status may not reflect the full history of benefits already received. The third method uses technical surplus to purchase additional guarantees. Instead of paying cash immediately or waiting until maturity, the insurer increases the benefit package while preserving its initial structure. The quantity denoted by SP is the first order price of 1 unit of additional guarantees. It has the structure of a reserve for benefits only, with no premiums. If the cumulative number of purchased units is denoted by D, the first order reserve is increased by the value of these additional units. Benefits and transition benefits are then multiplied by 1 plus D. This mechanism creates a feedback effect. Once benefits are increased, the future surplus rate also changes because the reserve and the capital at risk change. The chapter summarizes this feedback in equation 10.6, where the growth rate of D is the sum of a direct purchase term and a term proportional to the existing number of additional units. This is why equation 10.7 gives an exponential type accumulation formula during a stay in a given state. Actuarially, the attraction of this method is that it links bonuses to the insurance guarantees themselves. Policyholders receive more protection rather than an isolated terminal payment, and the original structure of the contract remains intact. This also reduces the risk of allocating large cash bonuses to policyholders whose previous claims history already generated substantial benefit payments. The last substantive part of the presentation is numerical. The purpose is not only to compute surplus values, but also to compare the qualitative implications of different bonus allocation methods. The disability insurance example is especially useful because the policyholder can be active, disabled, or deceased, and the timing of disability strongly affects both benefits and surplus. The numerical illustration considers a disability insurance contract with 3 states: active, disabled, and deceased. Recovery from disability is excluded, which is deliberately conservative from the insurer's perspective. The contract pays a continuous unit annuity while the insured is disabled. Premiums are paid continuously while the insured remains active, but only up to a date 5 years before maturity. This restriction avoids negative reserves near maturity. The first order biometric assumptions come from Danish practice reported by Ramlau Hansen. The first order interest rate is 4.5%. The second order basis is obtained by multiplying first order mortality and disability intensities by constant factors. Mortality and disability entry are lower under the second order basis, while disabled mortality is kept unchanged in the example. The actual interest rate is 8%, so financial surplus is generated because the actual accumulation rate exceeds the guaranteed technical rate. For a policy issued at age 30 and maturing at age 65, the expected present value of the total surplus is 0.144. This should be compared with total expected premiums of 0.423. The surplus is therefore economically significant. It represents roughly 1/3 of the expected premium amount. The numerical results reveal an important weakness of terminal bonus methods. For a policy issued at age 30, the terminal bonus paid at age 65 would be 2.13 for an active policyholder and 5.12 for a disabled policyholder. At first sight, this may seem consistent with the state-dependent calculation because disabled policyholders are associated with particular surplus paths. But from an actuarial equity perspective, the result is hard to justify. A disabled policyholder has already received disability annuity benefits, whereas an active policyholder has paid premiums without receiving those disability payments. Paying a much larger terminal bonus to the disabled policyholder may therefore over-reward a policyholder who has already benefited from the contract. This is why the chapter argues that increasing benefits is often more coherent. The second table in the chapter shows how the additional benefit factor evolves. For a policyholder active until age 60, the annuity amount upon disability can increase substantially as maturity approaches. For a policyholder disabled immediately after inception, the increase is smoother and depends on duration in disability. If disability begins at age 40, the initial annuity is increased to 1.14, and after 10 years of disability, it becomes about 1.58. The mechanism is therefore sensitive to both age and duration. Let me now conclude. The chapter has shown that the same multi-state framework can handle two apparently different problems: early termination through surrender and redistribution of surplus through policyholder bonuses. In both cases, the reserve remains the central object. There are four main takeaways. First, surrenders can be represented very naturally by adding an absorbing state to the multi-state model. This confirms the flexibility of the framework. Policyholder behavior can be incorporated through transition intensities, just like biometric or contractual transitions. Second, when the surrender value is below the mathematical reserve, the surrender charge reduces the reserve in the model, with surrender relative to the model where surrender is ignored. This result follows directly from Sealer's equation and from the non-negativity of the surrender charge stream. Third, technical surplus is the counterpart of prudent first-order bases. It can be decomposed into a financial component driven by the difference between actual and guaranteed accumulation rates, and a biometric component driven by differences between first-order and second-order transition intensities, weighted by the capital at risk. Finally, surplus allocation is not merely an accounting exercise. Different mechanisms can lead to very different distributions among policyholders. Terminal lump sums are simple, but may conflict with actuarial equity. Increasing guaranteed benefits is often more consistent because it preserves the insurance nature of the contract and links bonuses to the evolving guarantees. The chapter remains within a Markov framework, but the conclusion also notes that semi-Markov models can be embedded by augmenting the state space.